Today I would like to analyze Pfizer, one of the largest pharmaceutical companies in the world and one of the worst performing stocks in the last 5 years. The stock price is down around 56% from 2021, so we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 146.09 billion US dollar. This makes Pfizer the 10th largest pharmaceutical company in the world by the market cap. We also have a huge dividend of 6.78%, which we can see here did grow in a decent rate in the last 10 years as well. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2020, the revenue was around 41.65 billion US dollar. This was a decent growth around 2% from 2019. In 2021, we saw the incredible growth around 95%, so probably related to COVID. Then in 2022, we saw the very strong growth around 24%. This is also something we like to see, but then in 2023, we saw the strong decline around 41%. But I think it's also understandable because the years before we saw the very strong growth. Then in 2024, we saw the good growth around 6.8%. So overall, I think in the last 5 years, we had a very good revenue growth. So as a check here. The next thing we're looking for is the free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 12.18 billion US dollar. This was a very good growth, around 15% from 2019. In 2021, we saw the incredible growth around 145%, so probably related to COVID. Then in 2022, we saw the decline around 12%, but I think it's also understandable because the year before we saw the incredible growth already. Then in 2023, we saw the very strong decline around 81%, and this is something we don't like to see. And then finally in 2024, we saw the increase again with an incredible growth around 105%. But overall, I think we saw the decline in the free cash flow, so it's not a check here. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for an undervaluation. So we're going to take the free cash flow from 2024, around 9.84 billion. Then we're going to divide it with the current market cap, 146.09 billion. And then we're going to get the free cash flow yield for 2024, and this is around 6.73%. And I think it's a very good free cash flow yield actually. It's over the 4% that we're looking for, so the check here. But we can also recognize that the dividend yield is higher than the free cash flow yield. And I think this is not very good actually, because it means they cannot really afford to pay the dividend right now. We can also take a look at the future assumptions of the free cash flow. We can see here is assumed in 2025 around 9.8 billion, in 2026 around 12.3 billion, and in 2027 around 18.4 billion. Maybe these numbers are a little bit too optimistic, so let's assume for 2027 around 15 billion. Then we're going to divide it with the current market cap as well, 146.09 billion. And then we're going to get a free cash flow yield for 2027 with our free cash flow assumptions. So the number we're going to get would be around 10.26%. And that's very high, and in my opinion, an indication for undervaluation, but only if they can actually get the free cash flow around 15 billion US dollar in 2027. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with a free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. So we can see here around 57.8 billion. So I already think it's a huge number. So we can also take a look at the short-term debt. So we can see here around 7 billion. Then we're going to divide it with the current free cash flow, 9.84 billion. And then we're going to get the debt to free cash flow ratio that we're looking for, and this is around 6.58. So in my opinion, it's not a very good number. We would like to see that number under 5, so it's not a check here. And it means in around 6 years and 6 months, we take to pay back the debt with a free cash flow. We can also take a look at the cash on hand, how much money this company has in the bank, and this is around 20.48 billion. And I think this is a very good number actually. So overall, I think this company not has a great balance sheet, but it's also looking not too bad in my opinion. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. First, you're going to calculate the enterprise valuation. So this is the current market cap, 146.09 billion. We're going to add the debt as well. This is around 64.8 billion. We're going to take minus the cash, 20.48 billion. And then we're going to get the enterprise valuation, so how much the whole company is worth. And the number we're going to get would be around 190.41 billion. So now we're going to divide this number with the current free cash flow, 9.84 billion. And then we're going to get the ratio that we're looking for. And this would be around 19.35. And I think it's a decent number. It's under the 25 that we're looking for, so it would be a check here. But in my opinion, it's not an extreme undervaluation right now. But let's assume for 2027 we can reach the 15 billion. So then we're going to get a different ratio. So the number we're going to get would be around 12.69. And I think this is a great number actually. So if this company can actually reach the 15 billion US dollar in 2027, then I think this company would be undervalued. But with the current free cash flow of around 9.84 billion, I think this company is not really undervalued right now. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially we think the company is undervalued. So we can see here the shares outstanding increase in the last 5 years. This is something we don't really like to see. It means the company puts more shares on the stock market to get the higher financials. So I think it's also understandable for this company because they already have the very high dividend yields, so they pay a lot of the free cash flow towards the dividend. And I think they not have much financials left to buy back their own shares. So it's not a check here, but overall I think it's smart for this company to not buy back their own shares at this moment because they cannot really afford this as well. Can Pfizer stock be a good buy right now? The stock price is down around 56% from 2021. So let's start with a positive about this company. I think we had a good revenue growth in the last 5 years. I also think the free cash flow yield around 6.73% is quite good. And in 2027, with our free cash flow assumptions, the free cash flow yield could be around 10.28%, which would be an indication for undervaluation. The enterprise valuation to free cash flow ratio around 19.35 is also quite decent in my opinion, and in 2027 with the free cash flow assumptions of 15 billion US dollar, this ratio could be around 12.69, which would be an indication again for undervaluation. What I don't really like to see about this company is a bad free cash flow growth in the last 5 years. This is something we don't really like to see and is very inconsistent as well. The balance sheet is also not looking very good. So the cash amount is quite good actually, but they have very high debt. So this is something we don't really like to see as well. Then we also have a high dividend yield. So first is something positive. We like to have a high dividend, but then again, they cannot really afford to pay this dividend because the free cash flow yield is lower than the dividend yield. So this is something to consider as well. I think this company has potential, but only if they can reach the 15 billion US dollar in 2027. If they cannot reach this number, I think this company could be overvalued right now. If you found this video helpful, don't forget to like and comment and subscribe for more content.